All right, so I'm going to do two last questions for this chapter. Keep in mind, some of the questions I am skipping because these are questions from the prior chapter. So if you still have confusion with those questions, just go back to the prior chapter videos and just redo all the work. So PQ2-15. A business has assets at the end of the period of 520,000 and owner's capital of 100,000. Retained earnings at the beginning of the period are 150,000. Profit for the period is 80,000. And dividends paid during the period are 20,000. What are the liabilities at the end of the period? So in this specific question, we're going to start off with the ending balances. So we have assets, liabilities, and equity. So there's no set way to kind of answer these questions. It's just you kind of just have to wing it and just use your knowledge that you have, the formulas that you know to kind of back yourself up into the answer. So what we want to first do is we want to plug in the variables that we have. So we have 520,000 over here for assets. And then simply put, we can solve for equity by using the other variable. Because remember, equity is a product of equity equals to owner's capital plus retained earnings. So equity equals to owner's capital, which is 100,000 plus question mark. So now we have to figure out retained earnings. So retained earnings equals to beginning balance plus profit minus any dividends. So retained earnings, once again, equals to beginning balance, which is given to us, 150,000, plus profit of 80,000, subtracted by 20,000. So once again, 150,000 plus 80,000 minus 20,000 gives us $210,000. That's our ending retained earnings balance. So now we could easily calculate equity plus $210,000. That means equity is going to be equal to 100,000 plus 210,000. Now we have two of the variables within this formula. We could easily solve for liabilities by taking total assets and subtracting equity. Once again, we could rearrange this formula into liabilities equals to assets minus equity. So total liabilities at the end of the period is $210,000. Now let's quickly go over to PQ2-16. Same situation. There's no set way to do these questions. It's just kind of, you have to just apply the formulas and just back yourself up into the answer. So now we have a bunch of beginning balances, assets, liabilities, equity. So beginning balance for assets is 362,000. For equity is 125,000. We could easily solve for liabilities once again by using the exact same formula over here. So liabilities is 362,000 minus 125,000, 137,000. During the year, the business earns revenues of 689,000. It has expenses of 524,000. So right now, I'm going to stop and I'm going to quickly calculate profit. So we know profit is a product of revenue minus expenses, $165,000. Now we paid a dividends of 80,000, correct? The retained earnings is a product of profits, $165,000, subtract dividends, which is $80,000, given to us directly in the question. So now we can calculate ending retained earnings. 165 subtract by 80,000. So 85,000. So essentially, equity is going to increase by 85,000. So calculate the ending balances. Remember, equity is a product of owner's capital plus retained earnings. Since in the question, it doesn't tell us what owner's capital is, or it doesn't tell us that the owner invested more money into the business, we're just going to assume that owner's capital is 125,000. Simple as that. And the new retained earnings balance is 85,000. So we add those two together. And then assets at the end of the period is $402,000. Once again, we can solve for the missing variable now. Remember, once again, the counting equation is assets equals liabilities plus equity. Or we can rearrange this formula into liabilities equals to assets minus equity, or equity equals to assets minus liabilities. It's all the same thing. It's just rearranged. We're going to apply this formula. We're going to take assets and subtract it by equity to get $192,000, which is the ending liabilities. So the very last question is, if liabilities increase during the period, what are some of the possible reasons why they might have increased? So essentially, we kind of already talked about this. So remember, when you swipe your credit card, liabilities increase. When you take out a loan, liabilities increase. So that's are the possible reasons why they would increase. If liabilities decrease during the period, what are some of the reasons why? So we've talked about this already in prior videos. When we pay down our credit card, it's going to decrease. Or if you pay off our loan that we got from a friend or our family or our parents, it's also going to decrease in that sense as well. So once again, liabilities increase when your future obligation increases, but when you pay down those future obligations, they will decrease.